Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/Riiv to receive the top 10 stocks to buy right now. One popular segment of the market is video game stocks, and this has gotten a lot of attention, particularly in the pandemic when people were staying at home, playing more games. You would think that would have been a huge tailwind for the industry, and the video game market would be much better today than it was just a few years ago, but that's simply not the case. If we dig into the numbers, the profitability of the video game industry is actually going down. And there's some good strategic reasons for that happening. I want to dig into a few companies in the video game market that may have surprisingly slow growth if you're just a casual observer of this industry. And I think there's good reason to be really cautious about buying in this industry right now. I'm Travis Hoium. Thank you for watching Riiv Investing. Please subscribe here on YouTube to get access and notifications for all my investing coverage. Let's just lay the groundwork of what the video game industry looks like right now. And I want to highlight three companies: Electronic Arts, Activision Blizzard, and Take-Two Interactive. You can see here that the market cap of these companies are very large. Activision Blizzard is in the process of being acquired by Microsoft if that deal is approved. But the other standalone companies are $31 billion for Electronic Arts and $19 billion for Take-Two Interactive. These are also not cheap stocks. You can see here that Activision Blizzard and Electronic Arts are trading for over 30 times earnings. Take-Two Interactive actually has reported a loss over the last year, so they don't have a price to earnings ratio as a result. But these are fairly expensive companies on the idea that their earnings are going to grow over time. But is that actually what we see? And the answer to that is an unequivocal no. You can see here that revenue has actually been fairly flat over the last 5 years, especially when you consider all the acquisitions that have taken place. This jump in Take-Two Interactive's revenue over the last year has been a result of them buying Zynga. Electronic Arts acquired Playdemic and Glue Mobile, so that has added to their revenue. And you can see that Activision Blizzard, while the results are a little bit choppy, their revenue has not really grown over the last 5 years, despite the fact that people thought that we were going to be spending a lot more money on video games during the pandemic. Now let's look at the earnings trends, and we see the same thing here. Net income is not growing in the same way that you would think if you just think that video games are a growth market and this is a great place to be as an investor. It's actually a really difficult business. There were some nice increases periodically during the pandemic. You can see Electronic Arts did really well in early 2020. Activision Blizzard did a little bit better in 2021, but those numbers have normalized over the last few years, and these simply aren't consistently high growth profit companies. So the question is why? And I think this gets to the dynamics playing out in the video game market right now. If you think about financial power in the video game industry, it really lives in two ends of the market. There's the big players that are aggregating a lot of content together, like Microsoft with its Game Pass, like Sony with PlayStation. Those are really the power brokers in the video game industry. Not only do they make consoles, but they're the ones that control the flow of money even in a lot of the digital applications. You can put Apple and Alphabet with their Android operating system in this segment as well. They're going to take a cut of every single game that's sold. They don't actually care which game you're playing, whether you're playing a big game or a small game, because they're creating the platform. So think about these as the platform companies. At the other end of the market, you have niche players. This is highly valued games, people that maybe don't have hundreds of millions of users, but have people that will spend a lot of money on a niche game. These aren't necessarily publicly traded companies, but they can generate a lot of value with not necessarily a lot of investment, in part because they're building on common gaming engines. The gaming engine companies games are primarily built on Unity or the Unreal Engine. This is the other platform segment in the video game market. If developers are all building on the same tools or similar tools and have similar capabilities, then one specific game company doesn't have as much of an advantage over another. So what you see forming is this middle tier of companies like Activision Blizzard, Take-Two, and Electronic Arts, who are kind of stuck in the middle. They're not a platform. They don't make niche games. They make games that are very expensive, very costly to develop and take years, and then need to have hundreds of millions of players both playing the game and paying for it over time. But it's not a consistent business, and it's really a hits business. So if you don't have a big hit year after year, then you're not the profit machine that investors might think. In this smiling curve, this is on the vertical axis, we're seeing the value creation, and that value really accrues to either niche players or big platform players. These three gaming companies are neither. They're stuck in the middle, and that's the reason that we see revenue flatlining and net income not being as high as you might think for a lot of these game companies. So should investors be paying a high price for these stocks? I think the answer is clearly no. I would not be paying a price to earnings multiple of over 30 for a company that's not growing and does not have a powerful position in the market. That's where the video game market sits today. That's just the reality. That's why I am staying out of video game stocks. I would even caution that Activision Blizzard, which is in the process of being acquired by Microsoft, if that goes through, could fall significantly if it doesn't. Yes, the stock trades for a discount to its acquisition price. So if the deal does go through, you can get a premium for that. But what happens if the deal falls apart? The company's going to fall back to where it would be trading at normally. And in a down market where results are not improving quickly, I think the stock could really fall significantly. So take these as words of caution for the video game industry. I think these stocks have gotten very much ahead of themselves. A decade ago, you could get a lot of these for a 10 price to earnings multiple. I would be very comfortable paying that for these stocks, but I'm definitely not going to pay 30 times earnings. What do you think about video game stocks right now? I'd love to hear your comments in the comments section below. Follow Riiv Investing here on YouTube. Thanks for watching, and I'll see you here again next time.